Welcome to Passport to Wealth, the podcast for U.S. expats ready to take charge of their finances while living abroad. I'm your host, Arielle Tucker, a certified financial planner, enrolled agent, and fellow expat, here to help you navigate the complexities of cross-border life with clarity and confidence. Okay, welcome back to Passport to Wealth. Today, I am joined with Matthew Hitchcock, who is a CPA, and he is the founder and managing partner of Hitchcock Partners GmbH, a boutique tax and advisory firm based in Zurich. With over 15 years of international tax experience, Matthew specializes in helping U.S. citizens and cross-border families navigate the complexities of U.S. and Swiss tax compliance, financial planning, and global mobility. Prior to founding his firm, he worked in both Big Four and private practice roles across Europe and the United States, giving him in-depth insights into the unique challenges faced by expats and globally mobile individuals. A longtime resident of Switzerland, Matthew is passionate about delivering clear, personalized guidance to clients who live, work, and invest internationally. His approach blends technical expertise with a commitment to client education, ensuring that each and every individual feels confident and informed in their financial decisions. Matthew, thank you so much for joining us today.
Yeah, thanks. Thank you, Ariel, and thanks for the introduction.
And I've had a really fun time getting to know you because we're in this little U.S. expat group that serves other U.S. expats living and working in Switzerland. So that's been kind of like a fun connection to kind of get to know you a little bit better and learn more about your practice. And so I was so excited when you agreed to come on the podcast and talk to us about everyone's favorite topic, PFIC.
Everybody's favorite topic, PFIC. Yeah. For those that have trouble sleeping at night, that is.
Yes, this will be a great episode if you're listening and you're like, I don't even know what these people are talking about. So let's start at the beginning, Matthew. What exactly is a PFIC and why should you as expats living abroad care about them?
Sure. Yeah. So a PFIC is an acronym that is you'll hear thrown around amongst expats and tax advisors, and it basically just stands for Passive Foreign Investment Company. This is a regime that was enacted with the 1986 Tax Revenue Act, and the intent behind these provisions was to eliminate what the U.S. Congress deemed to be an inappropriate deferral of income from the U.S. tax net. And so, maybe a little bit of a history lesson. Back in the 70s leading up to mid-80s, wealthy individuals and not only wealthy individuals, but individuals were able to invest in a tax preference way by putting their money in non-U.S. based mutual funds that generally weren't subject to U.S. tax as long as they were reinvested. And so what this did is it allowed investors to have higher rates of returns on non-U.S. investments in mutual funds than they would in U.S. investments. So as you can imagine, the mutual fund scene did not find that to be a appropriate thing for our U.S. tax system to basically encourage, if you will, investment outside the U.S. And so they enacted this regime, the Passive Foreign Investment Company regime, that basically seeks to eliminate that tax advantage of investing in a fund or an investment, a portfolio investment outside of the United States.
Okay, great. Thank you so much for setting the stage for us a little bit there. And so what types of foreign investments typically fall under this category?
I think when we talk about PFIC in the expat context, right? There's a number of ways that you see this come up in practice, but I think the one that everyone has at least heard of or is familiar with is the concept of owning a non-U.S. fund. And so basically the way that the PFIC rules work is they basically say an investment in what's considered to be a corporation for U.S. tax purposes, so a fund, if it generates income that's considered passive of 75% or greater, or it has assets, the value of which is 50% or more passive generating income assets, that this fund or this investment, if you will be treated as a passive foreign investment company or a PFIC. So that's kind of what a PFIC is in a broad brush. And so again, where we see this come up in the expat, individuals living abroad, a little bit different in a closely held business context, but we think of non-US based mutual funds, really.
Yeah, and this is where I am having conversations with our clients, every day, about they want to invest abroad, and we start to talk about the limitations about investing abroad and some of the tax traps of investing abroad.
Sure.
So if you were just to go and open a foreign brokerage account and were able to then buy foreign mutual funds or even sometimes foreign ETFs or other foreign funds, these all have a foreign ISIN number. And most of the time, your tax advisor is going to then treat those as PFICs, right? Or they're going to charge you to do the research to prove that they're not PFICs
Right.
so that they can classify them correctly. And I'm really curious for the clients that you're working with, like, are you doing research? Like, are you saying, okay, I see your foreign portfolio. I see all these foreign ISIN, the registration numbers of the fund. I need to now go and do research on them, or I'm able to just say, no, these are going to be PFICs. Like, how do you approach this when you see this?
Yeah, well, there's unfortunately no one size fits all approach. And I think that's part of the reason why we tell people to stay away from PFICs if they can, because it's, it depends on how much money are they investing in this fund, how many funds in general are they invested in, what's their strategy that they're really trying to, I guess, walk with when making these investment decisions. So it's tough to say. Again, there's no one size fits all approach. I think some funds they warrant some additional research, but I think your general fund, non-US fund, I mean, I think it's a pretty safe assumption that it's going to meet one of these either asset or income tests, in that the income it's generating is going to be 75% or greater passive type income, or there's going to be the assets that are generating that are 50% or greater passive generating assets. So whether additional research is warranted, it's really going to be a facts and circumstances case. I mean, I think if someone's putting 3 million in a fund, we're going to probably spend a little bit more time kind of understanding what the tax ramifications are of that, as opposed to someone who is, just buying up pieces of foreign mutual funds and has a relatively low investment in them.
Yeah, and I think like a great example of kind of that low investment tier is when we come across Americans with like a Pillar 3 account,
Mhm.
right? And that's a Swiss Pillar 3 retirement account that's not recognized by the US. And so basically the US will view that as like a foreign brokerage account, right? And you can only put 7 or 8,000 Swiss francs a year into that account. And then you go and you maybe want to buy 4 or 5 different ETFs, mutual funds, they're all foreign, they're all classified as foreign. And this is a great example of like, this can make your tax filing very expensive and much more complex than you're anticipating, cost you a lot on the compliance side, even though we're not talking about a lot of money.
And I think that is the tagline for this conversation, because I think that as you go and you decide you want to make investment decisions, when it comes to compliance in the U.S., you are a lot of times limited in the amount of information that you're actually able to get when it comes to investments in a third pillar account. How much income are these investments really earning? How much am I putting into each specific one of these mutual funds? A lot of times those decisions, they're not made by you. They're made by the fund advisor, the third pillar account advisor. And so and this is what I kind of going back to this one size fits all approach. You can't have that, because each particular, I guess, provider of these plans are going to have different information that they're going to be able to provide you. And a lot of times it's not the information that's needed to make a U.S. tax determination. So you find yourself kind of trying to logically box yourself into, well, what would this be like on its face, kind of in the absence of complete and good information.
Yeah, and I guess on the other hand, the example that I keep thinking about are the clients who have come to me and they have, significantly more assets. They're looking to hold those assets very
Mhm.
intentionally outside of the US for a particular reason. And then they are coming and maybe they've bought a fund and they are going into it knowing the reporting considerations, but it's part of their broader investment plan. they accept the trade-off, right? Yes, I'm going to have to report this to the IRS. Yes, I'm going to have to pay more on the compliance side. It adds some complexity and potentially some additional tax exposure. I'm accepting that because it accomplishes something else. I would say for the average person, that should be like 500,000 at the very minimum, really more like
Absolutely.
over 1 million in those ones to really make it worth it. If you're like, I'd really like to hold 50,000 outside of the US right now, it's going to come with such a cost and complexity that it really is just like the trade-off really isn't there for me.
Yeah.
I'm curious what
I
your
no, I actually I think that's great. And that's another thing that I, like to point out to my clients is you never want to make investment decisions based on the fact you're going to have to fill out some complicated tax forms. I mean, if it makes sense to invest in something because you have enough capital that you're going to be putting into it, the returns are there that you're looking for. I mean, you don't not invest just because you're going to have a complex tax situation. Where I see this becoming a little bit more of an issue, though, is go back to your 500,000, let's just say euros investment in funds. I don't know that I'd be putting 500,000 and say, I don't know, 60 funds,
oh
and
yeah,
then
no.
think that, I mean, my return is going to get swamped up in just the complexity of the reporting required. So, I mean, I think, again, you never want to make investment decisions based on the potential compliance ramifications of that, but you do need to be mindful of the fact that there are these ramifications. And if you are going to be investing in non-US funds, you need to understand what the cost of that is, not just the brokerage advisor fees that you're paying, but also the US tax compliance component to that as well.
Oh, absolutely. Let's talk about what happens if you own a PFIC and you don't report it properly.
Sure. So maybe we can just real quick talk about it when we're required to report those, because there are a couple exceptions that can get you out of some of this
Yes,
onerous
let's start
reporting.
there. Yes, yeah,
Yeah.
yeah.
So if you own PFIX directly, as long as you own less than a fair market value of 25,000, there's no requirement to fill out some of these forms, and that's directly and
And that's per
indirectly.
fund.
It's per fund.
Per okay,
It's 25,000 together of funds. I don't believe it's a
okay.
per fund. I believe it's just in.
Oh no, no, I'm asking you. I'm like
Okay, yeah, no, it's
not me.
25,000
Okay.
directly, period. And then there are 5,000 indirectly through partnership. So you get there very quickly if you're invested in any partnership that has investments in these PFICs. So if you're under those thresholds, great, you're in the clear. No need to file the forms, and so it gets a little bit easier. What was the original question? Sorry.
Okay, so I'm wondering what happens. So, because this is another thing, right? People are doing a lot of DIY and on expat tax returns, right? I see this like you move abroad, you don't really know what you've been using TurboTax, and now you're like, I'm gonna go and like continue to DIY my tax return, and they will do that until they realize like, wait, I really make too much money and my situation is too complex and now I need professional help. And so now they're coming to us and we'll see these tax returns that I'm like, "Oh my
Yeah.
gosh, these are totally wrong." So, what is your advice for people who are now like kind of having to really kind of reconcile the fact that maybe the tax returns were incorrectly, they
I
never
understand.
picked up these PFICs, they didn't even
Yeah.
know what PFICs were or that they had them.
Yeah. So I mean, I think the biggest issue that you run into when you fail to report PFIX is that the statute of limitations to examine that tax return stays open indefinitely. So, and what that means is generally when you file a tax return, the IRS has 3 years from the due date of the tax return or when you file it, whichever is later, to examine a tax return and make adjustments to that tax return. In some scenarios, it can be 6 years if there's a substantial omission of income. But generally speaking, 3 years from the due date of the tax return or when you file, whichever's later. So if you fail to report a PFIC, so your your advisor invested you in foreign mutual funds, you did your TurboTax tax return, and then your CPA says, hey, where are these Form 8621s that are used to report PFICs? And you say, what's an 8621? The real risk that you run is that at any point in time, indefinitely into the future, if one of your returns were to get examined, they could open up and examine a return where you didn't report that PFIC. So I think that's the biggest risk. I'll be honest. I spent a couple years as an agent at the Internal Revenue Service, and I found that we were relying a lot of times on the advisors to tell us what PFICs were, just because it's just not a common thing that someone in the SBSE, the small business self-employed space, really runs up against. So now, do I think that there's some huge risk associated with not reporting? It's really tough to say, but I also wouldn't want to put myself or a client in a position where we are having to explain, oh yeah, we don't have the records for this tax return because we thought the statute was closed, when in reality it wasn't, because we just forgot to file one of these forms. So I think that's the main risk that comes to my mind. There's also, of course, tax risk. I mean, a distribution from a PFIC, it has a different tax treatment than just a regular dividend from a stock. So there could be a difference in the amount of tax that's actually owed. But yeah, that's the main thing.
Can you run us through kind of the differences in taxation from just an ordinary dividend to a PFIC, and kind of explain to us what is the punitive taxation or the potential tax exposure or the difference?
Sure. So, and we'll just assume that the company paying the dividend, that whatever country they're a resident in, they have a comprehensive income tax treaty with the U.S. So we'll just say Switzerland. So if you received a dividend from, say, Nestle, the maximum taxation that you would have on that would be 23.8%, and that would be a 20% capital gains tax and then a 3.8% net investment income tax on that. So, and again, the rate of that dividend, it could be 0, it could be 15. It's dependent upon, obviously, the income tax bracket that you're in. With a passive foreign investment company, there's what's called an excess distribution regime, where, and really the calculation of this, it's trying to mirror the U.S. mutual fund 90% passive income distribution requirement for RIC status. And so what it does is it looks to the last 3 years of distributions, averages them, and then says, to the extent that you have inappropriately accumulated funds, so you've taken a distribution this year that's 125% or greater of the average of the prior 3 years, we're going to treat that amount as if you earned it on a daily basis from the time you purchased the stock to the time of the distribution. And that's not going to get qualified dividend rate. So, I mean, you have to run the math on this. But basically the days are, you calculate and you prorate over the holding period, and then each amount of that excess distribution is subject to the maximum U.S. tax rate. So, I mean, I think in practice, when we see these and we see excess distributions, either because they distributed more than the 125%, or because there was an exit, there was a sale of that PFIC at gain. I mean, sometimes we see these taxes up in the 50%, depending upon how long they held it for. So you have to run through the numbers, but I think the description that I just gave of an excess distribution compared against just a standard dividend should kind of give you an idea of not only the complexity, but also the negative impact of holding and receiving income from a PFIC.
Has the reporting gotten easier? I mean, is the software better than it was when I was in accounting 10 years ago? And I remember lots of Excel spreadsheets and manual entries and the highlighter. Is it better now?
I would like to say it's gotten better. I wouldn't say it's gotten worse. We'll put it that way. But there are certainly a number of spreadsheets that have to be prepared just to be able to figure out what the tax exposure is. And this, again, kind of goes back to that cost benefit analysis. When you go and you invest in these, if you're doing these calculations for, millions of dollars, maybe you don't care as much about the reporting, because there are some elections that you can make to kind of mitigate the negative impact of this anti-deferral PFIC charge that I just described. But yeah, no, it's still a bit of a headache having to go in, figure out, what were my last 3 years of distributions. I might have just picked this client up this year and they may not have, filed returns for the previous 2 years. So I might have to go and figure out and, pull public data to figure out, well, what distributions were these funds taking? And again, it's tough because it's not a one size fits all approach. And that's exactly why it's so expensive to comply with these rules, because it's not usually as simple as just asking the client, hey, give me this information, because they don't know, they don't have it readily available, and it has to be researched.
Yeah, I think this is what I love so much about the work that we do is there's like this detective element to it. Right? Like we are getting out, we are digging in, and every situation is just so unique in the cross-border space. And
Yeah.
I love that. I love like the detective and the puzzle.
Well, it never gets boring.
Yeah, exactly. Um, you know, thinking about individuals who are preparing to move abroad or are listening and are currently already abroad, what are some of the proactive steps that they can take to avoid PFIX altogether?
Yeah, I mean, I think the main thing is not to listen to your foreign advisor. No,
Yeah.
I think, in my experience with, investment advisors here in Switzerland, and also very much so in Germany, is they tend to recommend these DWS funds and these investments that clearly are going to fall within this PFIC definition that we've talked
Which
about.
I
So
find so interesting, not to interrupt you, but to interrupt you,
yeah,
because Germany has its kind of similar PFIC regime, right? From 2018, right? They came out with these kind of similar
yeah,
ideas.
investment
And
Steuergesetz. Yeah, I know what you're talking about. Yeah,
so,
no, yeah. So I mean, it would only make sense that a German advisor would think, oh, well, maybe the U.S. has a system similar to us, but in reality, they don't. And a lot of times, what they will recommend is, foreign-based mutual funds, and again, it makes their job easy, right? Because you can get a fund that's high risk, high growth, low risk, you know, simple income. I mean, there's fun for everything, and so it's very easy for an advisor to just, make a blanket statement. Well, let's just put it in foreign mutual funds. The issue is if you're not aware of this PFIC regime, and then you do end up working with an advisor, say after preparing your messed up return, you're going to run into this PFIC issue. And I think the most proactive step that you can take really is listening to something like this and just being aware that this exists, and understanding what are the risks if I just choose to ignore this altogether. And I think if you balance that risk with kind of just a general broad understanding of when you could run into an issue, I think that's the proactive step that I would take, is just really informing myself.
I think that's what this podcast is here for, right? Our
Yeah, that's
podcast
great.
is here to raise the orange flags so that, because I find so much of cross border taxation planning, you don't know what you don't know. And it's like you
Yeah,
don't know what you don't know until you have enough money and complexity to realize you actually now have a problem.
yeah,
And so my goal is like, how do we just kind of keep you outside of trouble, keep things simple? But I loved your point about your foreign advisor. And that's any advisor. That's, the water cooler talk you're having with your colleagues who are non-US citizens, and you're talking about money. What are you doing with their money? What works for a non-US citizen abroad is probably not going to work for you as a US citizen abroad, right? We
yeah,
play by
absolutely.
completely different rules. I see this all the time with foreign tax advisors, right? They're getting into offering advice like, oh, especially in high tax European countries, right? Wow, this is your tax rate, and there are ways that we could lower this, getting you
Yeah,
into these additional private pension products or something, which are oftentimes just full of PFICs. And so
yeah,
I always tell our clients and individuals I talk to, the best first hire you should make is a good US accountant,
yeah.
because that's going to be the person to kind of keep you on the straight and narrow as you just kind of get everything sorted out.
Yeah, no, I mean, I think that's good advice, and yeah, completely agree. I think you don't know what you don't know, and particularly as it relates to local country stuff. And I think Just having a general broad awareness of this, it really can help you if you invest a little bit of time up front.
Yeah, absolutely. Matthew, thank you so much for joining us today. I really appreciate you sharing your insights and diving into such a fun topic like PFICs. I mean, I knew you were the perfect guest for this. So thank you so much for sharing your insights with our audience today.
Thank you, Ariel.
The content shared in this podcast is intended for informational and entertainment purposes only and should not be considered financial, tax, or legal advice. We encourage you to consult with a qualified financial advisor, tax professional, or other licensed expert before making any decisions based on the topics discussed. Everyone's financial situation is unique, and personalized guidance from a trusted professional is the best way to ensure your choices align with your individual goals and circumstances.